Welcome everybody to our latest webinar, which today is going to be a review of the key announcement from the spring budget, which was delivered a week or so ago. And also we'll cover off, as usual, some topical tax issues as well. As per usual, you've got the three of us presenting, covering business taxes with myself, private client matters with Vicky, and tax disputes and resolution topic with Paul. And just a note on Paul, this will be his last presentation to you all. Paul is getting a well-deserved and well-earned retirement, so this will be a farewell for him. So kicking off with business tax. And first of all, I just want to look at profit extraction, and this is in the context of the decrease in national insurance rates, which was announced. Vicky is going to pick that up in more detail in her slot, but I just wanted to pop this table up here, which basically shows what the impact of the latest change will have on that conundrum we're often faced with in terms of how should we take profit out of a company, or indeed should we incorporate into a company in the first place? And you'll note from this, as expected, the gap within the company between taking a salary and taking a small salary and the balancing dividend is decreasing as a result of the NIC decrease. Of course, the small salary and dividend figures haven't changed at all because there were no changes to tax rates on dividends. And when we're talking about a small salary here, we're talking about taking a salary which doesn't lead to an NI liability. So that just puts things in a little bit of context. And again, it just makes that decision about how to extract profits or whether or not to incorporate more timely and gives us some more food for thought there. So in terms of the sort of the headlines around business tax, and I'll come into these in more detail as we go through. First of all, the full expensing was made permanent and maybe extended to leased assets. The VAT threshold is increased to £90,000, and there was also announced some new reliefs for creative industries, including support for independent films. And the area I will spend a bit of time on as well are the changes to the furnished holiday letting regime, which are quite significant. So first of all, looking at full expensing for assets for leasing. So draft legislation will be published shortly, and the intention is to extend full expensing. So this is 100% first year allowances on assets used for leasing. This is general pool expenditure. So at the moment, you can claim full expensing for what's called background plant. So any plant that's incorporated into a building and that building is leased out. But this is looking at extending that even further. Now, the start date for this is unclear. What the Chancellor did say that this will be introduced when fiscal conditions allow, whatever that means. And I suspect it probably won't be Jeremy Hunt making that decision anyway. So watch this space on that one. Just looking at the VAT registration threshold increasing. So it's increasing from £85,000 to £90,000. So this is the first increase in 7 years. So probably long overdue in some respects. The deregistration threshold is increasing from £83,000 to £88,000. And these changes are going to apply from the 1st of April this year. And according to government figures, estimated that over 28,000 businesses will benefit from no longer being VAT registered in 24-25. So probably overall, maybe a welcome increase there. I mean, there is a school of thought that having a high VAT threshold limit may inhibit growth, because as people get close to that registration level, do they then not grow the business any further? But Who knows? Now, one of the big announcements, and I think probably in terms of announcements that were unexpected or not really trailed beforehand, was the abolishment of the furnished holiday lettings regime. And this is going to be from the 6th of April 2025. Now, the FHL regime has been on the statute books for over 40 years now. And what it does effectively deems what would otherwise be a property rental business to be a trade for certain tax purposes. Now, the reason why it was introduced in the first place was due to many tax cases at the time around the trading investment question in terms of when you're providing property on a short-term basis. So it was introduced to provide some certainty around that scenario. And of course, there are various conditions that you need to meet. However, from 6th of April 25, FHL businesses will just be treated as any other property investment business, which will have some significant impacts because there are many tax advantages of falling within the FHL regime as opposed to being what you might call a normal property business. So, for example, interest incurred on loans for a furnished holiday lets, they are just deducted against rental income and calculated in taxable profits for the business. From April 25, that will no longer be the case. You will then look at the interest relief rules around that relief being limited to 20% credit against the tax liability. So particularly for higher rate taxpayers, that will have quite a significant impact. As with all these rules, we don't know yet the detail in terms of how they're going to be introduced. We're just waiting for further information on that front. So from a capital gains perspective, both of an FHL asset by individuals at the moment, again, qualifies for business asset disposal relief. Very attractive. But from the 6th of April 25, again, it would just be like any other residential property. So you've got 18% CGT for basic rate taxpayer, or 24% with the new rate being introduced for higher and additional rate taxpayers. Rollover relief will no longer be available. Again, another benefit for an FHL business. Now, what the announcement did say that anti-forestalling rules will be introduced to prevent abuse of the CGT relief. Again, waiting for further details on that, but this will be there to stop people taking advantage of the FHL rules as they stand at the moment in advance of the change that's coming in. And just looking at a couple of other points around the FHL tax advantages. Capital allowances is another one. So FHL businesses are currently eligible to claim capital allowances, whereas property investment businesses with dwellings simply can't claim capital allowances on dwellings. So that's going to be withdrawn from April 25. Instead, you're then moving into the ability to claim a deduction for the cost of replacing domestic items. Now, how the transition is going to work here from an FHL trade into a normal property investment trade, again, waiting for details on that, whether there'll be balancing allowances, if there's a deemed cessation of the FHL business, for example, we just don't know. And finally, just looking at tax relief for pension contributions. So pension contributions limited to the hire of 3,600 or 100% of your net relevant earnings. And FHL profits are treated as relevant earnings for these purposes. So from April 25, property investment income isn't classed as relevant earnings, and therefore they would need other sources of income in order to support their pension contributions, and certainly would need to seek appropriate advice from an IFA to establish to what extent they have capacity to to carry on making contributions to the level perhaps they've been making up until now. And finally, on business taxes, just want to cover off a couple of changes to the creative industry tax reliefs. Maybe something that you don't come across very often, but when you do, there are some attractive reliefs out there and some new reliefs introduced. So as far as film and TV is concerned, there's a new independent film tax credit, which is part of the audio-visual expenditure credit. And this is films commencing principal photography from April 2024. And from April 2025, visual effect costs for film and high-end TV, they get an increased credit rate of 39% from 34%. And the way these credits work across all the creative industries are very similar in that you get an enhanced deduction for corporation tax, which you can then surrender for a repayable credit from HMRC. So it makes the funding of films and TV and things like video games tax credits as well with video games. It helps with the funding of those projects. And finally, with theatres, orchestras, museums and galleries, the previously announced higher rates of tax relief for static and touring shows, which is due to be phased down by 26-27. Chancellor has confirmed that these will remain at the higher rates of 40 and 45% on a permanent basis to provide long-term support to those sectors. So what I'll do now is hand over to Vicky to talk through some of the private client tax matters arising out of the budget. Thank you.
Thank you, Craig, and good afternoon, everyone. So I'm going to be covering off the key measures that impact individuals, and here's a summary of them. We've already touched on the furnished holiday lettings regime in Craig's section, so all of these are the ones that I'll be talking about over the next few minutes. So starting off with national insurance contributions, from the 6th of April, Jeremy Hunt announced that there's going to be further reductions to the national insurance rates for individuals. So for employees, the main rate of Class 1 national insurance is reducing down to 8%. So that's gone down from 12% to 8%. And this gives a maximum saving of £754 per tax year. For the self-employed, Class 4 national insurance is reducing further than it was anticipated. So it's going down to 6%. So that's a maximum saving of £1,131 per tax year. Then compulsory Class 2 national insurance is being abolished, which we were aware of. And so that means that most self-employed people won't have to pay it. And Class 2 national insurance rates are frozen. But just as a reminder here, these changes affect employees and the self-employed. But for businesses with employees, there is no cut in employer national insurance contributions, and those remain at the level of 13.8%. And then moving on to talking about some very significant changes that were announced, and I think a lot of people are waiting to see the detail of these and exactly how these are going to be brought in and what changes they're going to mean that individuals need to take into account over the next year. So the changes for non-UK domiciled individuals, they come in a year's time from the 6th of April 2025. And this is a complete overhaul of the personal taxation of individuals coming to the UK from overseas. So these tax rules, it's a very complicated set of rules anyway, but the current remittance basis regime is going to be replaced by a new residence-based foreign income and gains regime. And so this is actually going to result in higher taxes payable by non-domiciled individuals. So what we know so far is that where there's been 10 years of non-UK residence, the individuals can choose to have no tax on their foreign and income and gains in the first 4 tax years in which they're UK residents. And similarly to if they accept the remittance basis at the moment, the cost of doing that will be that they lose their personal allowance and capital gains tax annual exempt amount over those years. And there will be some transitional provisions to ease the impact on those that are already using the remittance basis regime. So when we look at some of the other sort of high level summary of what's coming in, newly resident individuals can use the foreign income and gains regime for the remainder of the 4 years. So in the first 4 years of residency, even if they've arrived before the 6th of April 2025, they can get the remaining time that takes them up to a maximum of 4 years. And those moving from the remittance basis who don't fall within that 4-year period will be able to pay tax on 50% of foreign income in the 2025-26 tax year. There'll also be the option of a rebasing election, which means that they can accept the 5th of April 29 value for capital gains tax purposes. And there'll be a 2-year temporary repatriation facilities. So people who have chosen to keep amounts of foreign income overseas, they'll be able to bring that into this country for a 12% tax rate. As I say, you know, this is quite a specialist area, so we just wanted to cover off in high level some of the key announcements. And obviously, if it applies to any of you or your clients, it'll be a matter of waiting to see the detail of what comes out in the finance bill and seeing how that's going to affect. And there'll also be wider impacts on individuals that are associated with offshore trusts. So there'll be a lot of activity with regard to these over the next 12 months, assuming that they still come onto the statute book on the 6th of April 2025. But obviously non-DOMs is a key area where different tax parties have got different views and are wanting to tighten up the rules on those. So moving on to some welcome changes that came in to do with the high income child benefit charge. This is a very welcome change to a system that was brought in originally in 2013 and has caused a lot of complexity, both to taxpayers, the revenue, and ourselves as agents. It's one of the most disliked areas of the tax system because of its unfairness and the fact that there's such a cliff edge effect that can affect some individuals and not others, literally depending on how much their taxable income is. So from the 6th of April 2024, the lower threshold has been increased from 50,000 to 60,000. So if individuals have taxable income below that threshold, they can get the full amount of child benefit paid to them without any of it being taken away from them. The higher threshold is also increasing quite significantly from 60,000 to 80,000, and the rate at which the child benefit is taken away from them has a slower taper rate of 1% for every £200 above the 60,000 threshold. So that is a welcome announcement for many individuals and households. And the aim by April 2026 is actually to move to a different basis, which would consider total household income. This will require quite significant changes to how HMRC gather data. And so it will have to see, you know, what information is required for that. But it would seem to be a fairer situation where you've got sort of sole individuals that are looking at that threshold compared to 2 partners or 2 husband and wife that are just below that 60,000 threshold. They could both have between them, you know, jointly up to 120,000 without losing any child benefit, whereas an individual can only have 60,000 before it starts to be tapered away. So that really is a welcome change. Then Craig's already alluded to this in the furnished holiday let section, but there was a welcome reduction in the higher rate of capital gains tax on property sales. So currently residential property gains are taxed at 18% where they fall within the basic rate band and 28% afterwards, so at the higher rate or the additional rate. The higher rate will be reduced to 24% for property sales that exchange on or after the 6th of April. So that 24% rate will apply to higher rate individuals or additional rate taxpayers. But this is just a reminder here that the 60-day reporting requirement runs from the date of completion. So it's important to be aware that property returns being submitted from the 6th of April 2024 may still be required to use the 28% tax rate if the sale exchanged on or before the 5th of April. Then briefly, there were some changes to stamp duty land tax, which obviously affects some people within the property tax arena. Multiple dwellings relief applies to the bulk purchase of residential property, and that's going to be abolished from the 1st of June, which will result in some higher amounts of stamp duty being payable. Then, in terms of inheritance tax, there were some items which come into effect from the 6th of April and from the 6th of April 2025. And so I just thought it was worth reminding people of previous announcements and some extra ones that were in the additional information with this spring budget. Now, it's unfortunate that no changes were announced to the inheritance tax thresholds. So there's no change to the standard nil rate band or to the residence nil rate band. But as mentioned in previous sessions of this webinar, there is a restriction in the definition of agricultural property relief and woodlands relief from the 6th of April this year, so that it only relates to UK property and not a wider area. So just to bear that in mind, if you or your clients have any land that would qualify for those outside the UK. There is an extension of agricultural property relief to environmental land management from the 6th of April 2025, and that's an area where there have been quite a few discussions about how that would work and whether agricultural property relief could be restricted. So that's a welcome change. Then from the 1st of April this year, there was some good news that personal representatives of estates no longer need to seek commercial loans to help them pay inheritance tax before applying for a grant of probate credit from the revenue. So again, that's quite a specialist area, but if it did apply, that's a very welcome change and does simplify matters and ease the burden for individuals in that scenario. Then linking into the non-domicile changes, there is a consultation on quite significant changes to inheritance tax, with the proposal that, you know, the regime for inheritance tax moves from the 6th of April 2025 to a regime based on the length of residence in the United Kingdom rather than domicile. Now, domicile has been the way that inheritance taxes has been based on for so many years, centuries in fact. So this is again quite significant changes that we'll all have to get our heads around. But again, that's not on the statute book, and that needs more information on that and to await the outcome of that consultation that's ongoing at the moment. And then some further reminders of previous announcements that do come into play in a couple of weeks' time. So whistling through these, the dividend allowance is further reducing, so that's going down to just £500. The capital gains tax annual exemption is reducing again, so that's just going to be £3,000 for individuals, which means a maximum of £1,500 for trusts. And where you've got an individual that's set up a number of trusts, those trusts might only have a £300 capital gains tax annual exemption, which obviously doesn't go too far at all. There's a simplification of tax matters for trusts and estates, which I'll come on to with more detail in a minute. We've got a restriction to where charitable reliefs can be given, similar to the agricultural property relief changes. That's now just going to apply to UK charities and community amateur sports clubs. We've got income tax basis period reform coming in. Again, this is something that I touched on in previous webinars, but it was been announced that individuals with income of more than 150,000, which is taxed through PAYE, won't need to submit self-assessment tax returns unless they've got another reason to do so. So initially that would seem to be, you know, a welcome change. It doesn't automatically mean they have to do tax returns. But as a reminder, people with income of that level have quite sophisticated affairs in a number of instances. And if you don't do self-assessment tax returns, you could be missing out on the ability to claim some additional reliefs and tax back in the form of gift aid and pension relief. And additionally, it's possible that you could actually be under declaring your tax liabilities, for example, if on dividend income and interest income. So again, that is something that needs to be carefully reviewed to make sure that taxpayers aren't either worse off themselves or aren't actually under declaring income to revenue and actually carry on to have tax liabilities that they need to notify to the revenue. And whilst a lot of those could be sorted out in coding notices, they're not the most straightforward of things to get right with the revenue. Then the cash basis for the self-employed and partnerships has been expanded and simplified. So again, there'll be some welcome changes. And just a note there that on the capital gains tax pages of tax returns, it's going to be necessary to separately identify crypto assets. And that's an area that the revenue are particularly keen on and sees an abusive area. And I think Paul's going to go into some more detail linked to crypto assets in his section as well. Now, I mentioned that there's some simplification for trusts and estates. Now, this is some welcome changes, but again, the devil's in the detail. So it's just remembering what you're looking at. And hopefully this slide is a useful reminder. So at the moment, there's a current concession where the only income to a trust or estate is savings interest and the tax liability is less than £100. And it's sort of an informal concession that says that you don't need to do returns or pay the tax in those scenarios. But from the 6th of April this year, there'll be a de minimis limit that will apply to all types of income. And those with income of £500 or less in total, so it doesn't have to just be from savings interest, it can be from other sources of income as well, will not have to file a return and the liability will be taken as nil. But the £500 limit will be reduced in the situation of trusts where the individual setting up those trusts has set up multiple trusts, and the absolute minimum that will apply to any trust in those circumstances is £100. Now, there are some slight differences here between whether we're looking at estates and trusts. So if you're a beneficiary of an estate that's fallen within that £500 limit, and so the estate hasn't had to do a return or paid any tax, and the beneficiary won't be charged to tax on the income. But if they're the beneficiary of a trust in a situation like that, then the beneficiary of the trust would have to pay tax on the income. So what this means is that interest in possession beneficiaries with available personal allowances in their personal capacity won't need to claim any tax back via the R40 repayment claims, as tax won't actually have been paid by the trustees where the income was less than £500. So they won't need to go and do an R40 to claim tax back. But those outside that scenario that are subject to tax will still need to pay additional tax on small amounts of income that they've received from the trust, and potentially need to do personal tax returns to make sure they're paying the right amount of tax on all sources of income. And again, linked to these changes, this is a change for discretionary trusts. At the moment, there's £1,000 starting rate band. That means that where income falls within that level, they're taxed at a lower rate of 20% instead of the standard rate of 45%. This is being removed from the 6th of April 2024. So there'll no longer be that starting rate band. And so the tax liability to trustees of discretionary trusts will increase slightly, with the added effect that that will simplify the tax pool slightly. Now, some other changes that were announced is that there'll be a National Savings and Investment British Savings Bond from early next month. And that will have a guaranteed interest rate for 3 years on investments ranging from between £500 and £1 million. They have also published a consultation on introducing a new UK ISA with its own 5,000 allowance. Now, the detail on that hasn't confirmed when that's coming in, and I think a lot of IFAs are thinking that that probably won't come in until the 6th of April 2025, but it'll be a matter of watching this space. There's been the welcome confirmation that the EIS and VCT conditions are to be extended to 2035 to ensure that the growth capital continues to be available to early stage innovative companies, because that was set to cease in the near future. So that's a welcome extension there. And there'll be legislation to address potential over-collection of tax and national insurance contributions where there's been non-compliance with the IR35 rules. And there has also been a consultation document released on raising standards in the tax advice market. And I know that that's something that the ICAEW in their budget update went into a lot of detail on, if anybody's interested in feeding into that consultation, for example. But again, that's welcome change to make sure that, you know, the advice that's given is up to a set standard and to give a level playing field in the market. Now, that's me completed on the main changes that are coming in from the personal tax side of things. I'll pass over to Paul to talk to you about his aspects. Thank you.
Thank you, Vicky. Good afternoon, everybody. Let's have a look at areas that are currently being targeted by HMRC. And to that end, I'm talking really since the turn of the year from when we last did the presentation in December. And as you'll see, that there has been quite a lot of activity by HMRC. To begin with, and this is picking up on a point that Vicky mentioned towards the end of her session, the crypto asset market. Apparently, HMRC's latest information indicates that around 10% now of the UK population are active to a greater or lesser extent with cryptocurrencies. And HMRC's experience and view and skepticism of this is that it has been very badly reported for a number of reasons, for tax purposes. And what they anticipate is that if they focus more attention in this area, it will lead to further income tax and capital gains tax being levied. It's income tax and capital gains tax because HMRC see this very much as, is it an investment or is it trading? And in HMRC's view, it's very much an investment, hence it's a CGT area particularly. And they've set quite a high bar as to whether or not it would actually therefore be trading. There would have to be a lot of activity for it to be trading and therefore liable to income tax. But HMRC believe that the actions in the crypto asset market have been poorly reported, shall I put it that way, and returned to HMRC for tax purposes. So what they've done is they've opened up a dedicated online service specifically for this particular area. And they are encouraging a voluntary disclosure. And the point of highlighting this is that there are probably clients out there that you may or may not know have had some activity with crypto assets. And it's well worth asking them to what extent have they, because now is the time, if a disclosure is required to HMRC, for that disclosure to be reported, not least because HMRC are taking this area very seriously. And in consultation with something like 45 countries, I think it is, around the world, they have put together and signed up to what they call the Crypto Asset Reporting Framework. And that will be implemented in 2027. So the incentive, if disclosures are required to HMRC, is for this to be done on a sooner rather than later basis. And HMRC accept that the taxation of crypto asset transactions is complex, but what they won't accept plainly is that then it isn't returned properly for tax purposes. And the reason that they are looking into the crypto asset market particularly is those of you that have reported into and dialed into the previous webinars that we've done, you may recall that I have covered off in one of them recently, what's known as the tax gap. Now, the tax gap is, in overall terms, what HMRC believe, in theory at least, is the overall yield from taxation in the UK when compared to the actual tax recovered and received. And there is a gap, and it's around about 35 billion. And they believe that a proportion of that, in no small way, is down to crypto asset mistakes. Hence them pushing this voluntary disclosure opportunity out there. Now, it is important to remember, if you do have clients that this may apply to, that bearing in mind this is an optional process, you then have to decide whether or not this would be the right route to follow in terms of making a disclosure to HMRC of whatever tax irregularities there may have been as a result of crypto asset activity. Because it depends very much on the behavior of the client as to which route should be followed. And for example, if there was deliberate concealment of this information from HMRC and non-disclosure of it, then the client is well advised to make sure that they would not be prosecuted. And the only way to ensure that is to go through what's known as the contractual disclosure facility, otherwise known as Code of Practice 9. And we've talked about that in previous sessions. If it's non-deliberate, and it may be that it was innocent error in the cold light of day, or it was careless, then bear in mind where the actual activities and the holdings of these assets, the bitcoins or whatever they are, where are they held? And decide whether the worldwide disclosure facility would be appropriate. But bear in mind that would not be appropriate if it had been done deliberately, or whether the general digital disclosure service would be appropriate if the holdings are UK based. Or you may recall I mentioned a moment ago, this particular disclosure facility, i.e. the crypto asset one, is in respect of income tax and capital gains tax only. So if there are other taxes that are needed to be disclosed, such as corporation tax or inheritance tax, then you would need to go down the digital disclosure service route. Another opportunity that HMRC is open to abuse in the tax system, and these are the online platforms now, quite apart from nothing to do with crypto asset necessarily. What we're looking at here is people who are buying and selling goods, items, services via online platforms. And HMRC have announced that they're going to spend £37 million to develop a system for online marketplace reporting. And they are hiring a team, full-time staff, to work on this project. This is all to do with websites that are used extensively now. All these names I'm sure will be familiar to you, certainly in outline. eBay, Airbnb, very common ones out there at the moment. And what these platforms have to do is, until January next year, is to report sellers' information for tax purposes to HMRC. And what HMRC are seeking to obtain is the actual amount of activity per individuals, the volume of activity. And they will require an annual report made to HMRC detailing the names of the individual sellers and the volume of their sales. So HMRC are serious about this now. This is not necessarily to do with a client who may just be disposing of an unwanted gift or an item that is surplus to requirements. It isn't about that. It's about people who are quite active now on these platforms. Bearing in mind that, strictly speaking, for tax purposes, they shouldn't register as self-employed if they are in turnover terms, as opposed to profit terms, receiving more than £1,000, which thereby would take them above the allowance and thereby make it liable to tax. And the information that's requested is quite detailed per individual. It's the tax ID, bank account details, and the total amount of the transactions. And HMRC go on to identify the sectors that they think are likely to be regularly affected by this. Taxi hire, for example, food delivery, selling handmade items, resale of clothing items, but not the occasional ones. Rental of properties for short-term accommodation, the Airbnb. Another campaign that HMRC are launching is what's referred to as their dividend disclosure letter. You'll be familiar from previous presentations, webinars that we've done, is these what's called one-to-many letters that HMRC send out from time to time, targeting a particular area of the economy or a particular sector or a particular type of taxpayer behaviour. And this one is very much directed at shareholders, directors, to do with dividend income and whether or not that dividend income has, believe it or not, being provided and supplied via tax returns to HMRC. You would have thought that that would be quite familiar territory to declare dividends, particularly in OMB situations, to HMRC. Would HMRC seem to think otherwise? And they have already started to review companies' accounts where, on the face of it, by looking at one balance sheet to another, year on year, a profit has been made, but the reserves are lower. So why is that? Well, quite probably because of dividend extraction. Bearing in mind also, as Vicky touched on in her session, that the dividend allowance is now going down to £500. Another reason why HMRC see this as a well worthwhile campaign, and another online disclosure facility for companies to register. And the point of all this is to make sure that you address these issues with clients who you may have acted for a long time. You may think you know their financial affairs well, but it's well worth putting all these campaign in front of them just to make sure that there isn't anything that they need to make a disclosure on before HMRC start to inquire. Another one, this is HMRC raids now on food takeaways. Another presentation topic that I covered a few months ago was this electronic till fraud, where a particular software provider would enable certain food takeaway outlets to suppress their turnover. And plainly, that's pretty basic tax evasion, suppression of profits for tax evasion purposes. And HMRC have undertaken a number of raids in England and Scotland to these outlets. And where they have got to at the minute is that they expect that they will be investigated via the Code of Practice 9 procedure, but in extreme cases, they are taking the criminal route and are pursuing them and taking those cases through to criminal prosecution under a caution. And there is an HMRC guidance leaflet on this. Electronic sales suppression, CF stands for compliance check, FS fact sheet 68. Here's one where actually HMRC have seen fit to engage with agents for once in a particular campaign. And this is looking at food delivery intermediaries are required to provide increasing amounts of data to HMRC. So this is your Deliveroo, for example, your Just Eats. And what HMRC are doing with this information is to identify discrepancies between the data that those providers have supplied as opposed to filed VAT returns. And what HMRC are doing about this particular matter is to actually write to the agents, asking the agents to contact them for what they call a redacted list of the taxpayers, so that they're basically turning the onus on this through the agent. And it's an attempt to make sure that if there has been an understatement of sales for VAT purposes, then there will likely also be an understatement of income for either corporation tax or for income tax purposes, dependent on the nature of the business structure. And if there are under-declarations identified, then there is a VAT voluntary disclosure form 652 that is required, or as will other tax declarations if other taxes are impacted. But it is interesting to see in this particular matter that HMRC are seeking the help of agents in this particular instance. The final slide is a quick update on the position with tax avoidance schemes now. We've covered these over the webinars on a number of occasions as matters have evolved and HMRC's initiatives have progressed. Where matters have got to now, it's taken HMRC a long time to really direct their attention to the promoters of these schemes rather than pursue the users of them. quite often the users themselves didn't fully appreciate, if they appreciated at all, what they were getting into for tax purposes. But over the years, apart from the disclosure of tax avoidance scheme legislation and the promoters, the POTAX legislation that came in some years ago, gradually the focus is being increasingly sharpened as to who the promoters are and what HMRC needs to do to curtail their activity. One of the things they put in place recently was to bring in what they call a stop notice, basically insisting that promoters to cease their activity in one or more schemes. And what they are now doing and have done, which has received royal assent on the 22nd of February with immediate effect, is it to bring in a new criminal offence to promoters. It also gives HMRC the power to disqualify directors of companies promoting tax avoidance. I mean, the irony in one sense is that a number of those boutiques particularly no longer exist. They have made their money from selling these schemes over the years and have folded and then disappeared. But I suppose from HMRC's perspective, they will pursue the remaining ones to try and ensure that they have basically trying to close them down, and they've said that's what they wish to do. In summary, therefore, and this is just to recap what we have said previously, if you have any client who is still tempted by a tax avoidance scheme that's put in front of them that still looks to be attractive in some way, the advice to that client is do not basically stay away from tax avoidance schemes unless you want a huge battle with HMRC and a lengthy tax bill in the following years. But the advice quite simply has to be tax avoidance schemes are a thing of the past. And there we have it.
Thank you, and thank you, Paul, in particular, for your excellent presentations over the years. I think it's fair to say your insight and knowledge is certainly going to be missed. It's been a pleasure having you on these webinars with us. We haven't got any questions in, which I don't know if it's a good thing or a bad thing. So we'll wrap this up for now. Then thank you all for attending. We'll see you all in about 3 months' time. The show goes on, and thank you all for tuning in.